All right, welcome. It's welcome to Win the Day podcast. We're Tuesday morning, and we have the esteemed Mark Violet.
I was looking around for somebody esteemed.
I'm looking at you here and trying to figure you out over here too. Mark Violet, who's an attorney and an owner of a title company and a guy who knows a lot about real estate, at least as it relates to Florida, as well as. Here's the thing. Florida's Florida for sure, and the rest of the country is the rest of the country. But a lot of this stuff, not all of it, but a lot of it is generally speaking fairly similar. Check your local markets for your own specific requirements. But what we're going to talk about today is generally speaking, if you have questions, fire them, right? We can answer pretty much, well, we'll see. If you have questions, fire them. We'll try to answer them. But we're going to focus the talk today on 1031 exchanges. If you don't know what 1031 exchange is, it's the section of the IRS tax code that allows people to defer, not get rid of, not dismiss, defer any capital gain, not any capital gains from having to pay them. You can push them down the road, kick the can, or whatever your terminology
That's
is.
the deferred.
Yep, the deferred.
Also known as like kind.
Like kind exchange, yep. So used by investors often because it has to be an investment property, can't be on a primary residence. Okay. Does that sum it up from your perspective?
Yeah. So what you allude to first was the good thing about 1031s is it's federal in nature. So no matter whether you call a Florida attorney, an Arizona attorney, a Minnesota attorney, all the answers should be the same because it's based on the federal code, not an individual state code. Now there's one little nuance though. Community property states versus non-community property states could affect whether if it's sold by a husband and wife, whether it has to be also repurchased by a husband and wife, or if they can split that up. So there's the one, I think that's the one caveat where it kind of comes down to a state specific issue, but that doesn't come up too often.
Okay. So here's the thing.
Mm-hmm.
We're talking Airbnb type properties. We're talking vacation rentals.
Right.
We're even talking long-term annual rentals, businesses, stuff like that.
So the business is going to fall under a different section of the IRS code. This is going to be for investment property purposes. So basically, when somebody calls me up and says, hey, I want to do a 1031, tell me about this thing.
So my business is going to buy a house.
No.
Unless your business is a house rental.
No, like kind exchange is going to require that it's real property for real property.
Mm-hmm.
Now, if your business owns real property, then you get into, you can do a 1031 on the property side of it, okay. But it's going to require, so the first thing I normally ask the client is, please tell me it's not your primary residence. Yep. You're not selling your primary residence.
Can't live in it.
Right. So you have on one end, primary residence, definitely not going to happen. And in Florida, if you're a married couple and you sell your primary residence, and you've lived in there 2 out of 5 years, you get a $500,000 exemption against.
$250 if you're single?
That is correct. Against any capital gain. So there's already somewhat of a buffer there if you're doing your primary residence. But on one side, you have the primary doesn't qualify for 1031. On the other side, you have we've never lived in it. It's investment property, rented out, clear as day. Then in the middle, we have what we call second homes. And a lot of times they have mortgages on them. And if you go in the public records, you'll find that with the mortgage, there's a rider that says, hey, this is a second home. So those are a little on the gray area where most of the time I will have a conversation with a client, find out, they're only allowed to stay in a second home or 1031 property no more than 14 times per year for maintenance purposes. Now, I will tell you there is no 1031 police. Usually it's a neighbor or somebody who turns them into, we'll just call it the IRS.
Be very careful, though, because with phones now and the ability for the IRS or otherwise to see where your phone is, that can be some issues. But I mean, whatever.
So usually it's I sold a property that I use as my own vacation rental, and I go there and I brag to all the neighbors how I didn't have to pay taxes on that. And you brag to the wrong person and they weed you out. And that's usually how it comes up. But
okay, so I'm gonna dumb this down because I deal with this every day. So it's fairly dumb already for me. But the way it works is somebody buys an investment property, an Airbnb, a house that they rent out annually to whomever and collect rent. Okay. It's very common investment practice, very smart, great way to go. One of the great benefits of being a real estate investor is the tax code is your friend at this point. And a big friend in that group of friends is the 1031 exchange. So when you go to sell the property, you can defer the capital gains tax if you buy another property and if that property is greater in value by at least $1.
Correct.
Okay. So
Perfect.
you can defer, and that's the government's way of getting you to sell one property and buy a bigger, new, different property. And
Yeah.
keep
So
the
if
whole
you
ball
if you
rolling.
buy, we call it original property and replacement property. So you buy the original property for $500,000. The market does well over the last couple of years. Now it's worth $1 million. You sell it for $1 million. You have two options at that moment in time. Basically, you can take your cash out, and you are going to have capital gains on
what is the rate on that? Do you know?
currently long-term capital
17?
gain is going to be 20%.
20%.
Right.
So 20% if on $1 million is significant.
Right. So you can take your lumps. So if you've got a $500,000 gain and you're paying 20%, you can run the numbers. That's $100,000.
That's significant.
Now you have 100,000 less, and it's also going, I call it a melting pot, your taxes. That's one line in your taxes. So everything may go up because of long-term capital gains.
It's on a graduated basis.
We're getting closer to the accounting side. So we'll let accountants answer those kind of questions.
Okay, so back to it.
Right.
You have a property, you're smart, you invested, you inherited, you whatever, somehow you ended up with this property. Yay, that's how you get wealthy. When you decide you want to sell it to buy a bigger, better property that's going to go up farther, faster, or whatever, you can do that. And you can defer that capital gain by buying this new property. People do it all in our world. People do it all the time, and you should be aware of it. Now, how you do it, it impacts how you sell. And I know in the state of Florida, if you're selling or buying a property using a 1031, you have to disclose that on the purchase sale agreement. And here's the thing. When you sell a property via a 1031 exchange, you never touch the money. It goes to what is called a third-party disinterested intermediary. Right?
Right.
Somebody doesn't have any say in it or whatever. So Mark is that person. If we were to sell here, he would do the closing. His company would hold the gain until you purchase the next property, and then you let a check go from.
Right. So back to ours, you bought the original property 500. You just sold it for $1 million.
Mm-hmm.
Before you go under contract, like you said, there needs to be language in the sale and purchase contract that the seller is selling the property in conjunction with a 1031 at no additional cost to the buyer. The reason for that language is the contract has to be assigned to the intermediary, which usually happens at closing. So can you imagine a buyer, let's say it's a buyer's market, and the seller is trying to do a 1031, and the buyer's being presented with an assignment of contract at closing, and the buyer says, I'm not signing that. Where does it say I have to sign that? Now, unless you drop the price down or give me something of value, I'm not signing that. And then the seller's going, well, if I don't do my 1031, I'm going to have a big tax liability. So that's the primary reason why you need to make sure the language is in the contract to avoid. Now, in an equal world, usually it doesn't, in reality, doesn't present a problem.
It almost never has, and it probably will now that we're talking.
But back to it. So assuming that doesn't happen, then at closing, the funds must go from closing company to the 1031 intermediary, which must be established before closing because there's additional documents like we just talked about.
John in New York brings up a good thing. Boot is the same thing as what? Gain?
So a boot is, let's say you sold for $1 million and you decided I only want to buy something of 800,000. You can still do that. It does not disqualify the 1031, but you're going to have what we call a basis. And just for easy math, let's say you paid 500 for the original property. You paid no closing costs or anything like that. So it was 500 dead even. And when you go to sell for $1 million, if you're doing a 1031, because you're deferring the taxes, your basis is still at the 500,000. So if you were to only buy at you sold for $1 million, bought at 800, you can see there's a $200,000
Are we in the weeds yet?
boot.
I feel like we're in the weeds. Are we in the weeds?
Too much, too soon?
No, I think you're bringing up the point that you don't have to spend all of that money, but what's left over, what the gap,
Which
you're
you'll
going
use.
to be taxed on that.
That is
That's
correct.
the boot.
Yeah, that's correct. Now, here's where it really comes into play. So back in the day in 2006, 2008, here's where people really
When
got in
the
trouble.
market's rolling.
Right. So let's say you bought something for 100,000. Boom, it goes up to 500 grand. You paid cash for it. Then you decide somewhere along the way, I'm going to take a mortgage out. And this confuses people. So it's worth 500 now. You paid 100. So your basis is only 100 grand. But you take out a $400,000 mortgage because the bank says, hey, we'll give you the money. Then when you go to sell it for 500, the IRS does not care that you took out a mortgage. It's still the difference between the 100 you paid and the 500 that you sold it for. So you have a $400,000 tax liability if you don't do a 1031. But then they're like, but I have a mortgage I have to pay off. I'm not getting that money. And like I said, the IRS doesn't care that you decided to take out equity from the property.
So here, let me bring it back into the real world too. Oftentimes you're going to hear people say, I would sell, but I don't want to pay the taxes. I'm not going to sell. I have to get I'm going to get a ton of capital gains. And they may not be aware of the 1031 deferment. So if you're not aware or you can't talk to it, that's a problem for you. You're going to constrict your ability to do business. So my hope here is that y'all understand that there's a 1031 deferment out there that allows somebody to sell an investment property and buy a different property, a bigger property, and not get stuck with the capital gains. It gives them a second door to operate from.
So John brings up a good point. There are timeframes. So let's talk about the timeframes.
Let's talk about the timeframes because you got to get moving.
Exactly. So closing date. Closing date is day 0. Once day 0 comes based on the settlement statement, then you have 45 days to identify up to 3 properties. So within that window of time,
Can it be more than 3?
No. Okay. You got to identify up to 3 properties. And if you're going to try to close on 3 properties, then there's certain rules. And again, we don't want to get lost in the weeds on the rules and percentages.
Hold on. 3 properties. You don't have to buy all 3.
Correct. No.
You got to buy at least one, though.
Most people traditionally just close on 1.
They're contenders.
Yeah.
Yeah.
And the reason why you want 3 is if maybe one sells to somebody else not available for you to buy. Maybe one chooses not to sell anymore. So you got to have some options just in case.
And then from day 0, closing date, you have 180 days to close
6 months roughly
on one of those properties that you have identified. And there's multiple types of 1031s. You have what we call the traditional. You sell, cash goes to intermediary, you find and you purchase. Easy one. We have reverse ones where you actually buy property before you have any cash. And then when you sell under the same time frames.
So maybe you have a property listed for sale, has not yet sold, but you want to buy the other one.
Right.
You can go ahead and buy the other one, and then the first one's going to sell after.
And that protects your dates. You're not under the crunch of the time. You still have timelines, but
But
you're
you
not
get limited benefit or less benefit.
Well, if you're concerned that the property you really want is not going to be there because you can't sell yours, that's how that would work. Those are a little more complicated and they're a lot more expensive than a traditional. We have what we call construction 1031s, where basically, again, you have an intermediary who will acquire the property. But the key is the builder has to be able to build and complete within 180 days, which in today's world, I mean, unless you're doing a small home or something like that, it's just not going to happen. So those are extinct.
So real quick, if you're going to do a 1031, you have 45 days to identify the replacement property.
Right.
Okay. And then you have 180 days from the closing to close on that property that you've identified.
And the IRS, they're days. They're not business days. If it falls on a Saturday, Sunday, legal holiday, so be it.
Days are days.
Right. And really, they've only extended once or twice in the history I've been doing this. COVID was one reason where they gave another, I think, 6 months to identify properties, but it's rare.
So here's the thing. Asterisk, underline, bold this. Not all intermediaries are equal. Okay. And none of them are backed by FDIC. You put your money somewhere, you're entrusting your money. Is that fair to say?
You do not have to be an attorney, a college graduate, and anything to be an intermediary, which I find
careful here.
Super interesting.
Wow.
You can sell your property, give it all the money to the intermediary, and that intermediary can take the money and run Venezuela, and you're out of luck. So be very, very cautious on who
I'd
you're
go
using.
somewhere else other than Venezuela.
Right?
I'll give you a really bad example, and this is a true story. You can probably find it on the internet. An intermediary decided in their agreement between the intermediary and the sellers, it said that the intermediary had discretion to invest the funds into whatever they deemed was the best avenue. So this intermediary actually invested the funds into breast enhancement augmentations.
Wow.
And it didn't go so well.
That's a growing
Maybe you say it flopped.
concern.
I don't know.
Big
The business was
feedback.
Yeah,
sagging.
it was a sagging business plan.
And the
Nice.
courts found him not liable for the loss of the funds because the sellers signed the 1031 document saying, we agree.
Wow.
So be careful. Do your
Yeah.
due diligence. All right, let's take it around the horn. Mark, give us some insight.
Well, I think the big thing is be aware of the timelines. And what I would tell most agents is don't get in over your head. Ask questions, build the relationship with someone like Mark, where you're not trying to be the expert. Be the librarian, not the library. Let's go talk to, and stay out of the ditch.
Destiny, what's your perspective?
Tell them to call their CPA. Keep it simple.
Julie, you've been around. You've probably done a good amount of these, I would think.
Yeah, we do a fair amount. I would say, Mark, talk about when it becomes a tax liability, because like you said, in Florida, if it's 250 or 500, I think is that a federal thing? I think that's the same in Arizona. Gain. And also if there's a difference between if you sell in under a year, under 2 years, those time frames, kind of like you said, if you've lived in the property 2 of the last 5 years, there's differences like that. But when does it become a tax liability versus when do you have the when do you get the break?
Yeah,
Where
the
it's
one
not a
thing
tax liability.
The one thing that we originally thought we were going to talk about but didn't address is these rules are made basically President Congress. And right now, originally, one party wanted to bump capital gains to 40%. I understand that's pulled back now to maybe a proposal of 28%, but no party is not above saying one thing and then when they get in trying to do something else. So some of the 1031s I'm having right now, I'm actually telling the sellers, listen, you need to consider right now it's only 20%. You need to project who you think is going to win. And if you think Republicans are going to win, then it's likely going to stay the same. But if you believe a Democrat's going to take president and they're going to own Congress, that may go up to 28% or 40%. So if you're going to do a 1031 at this moment in time, you're going to have to hold that property likely a minimum of 4 years until the next election. And there's time to change the capital gains back down, which usually what goes up doesn't tend to come down too often. So it's just another factor that clients need to consider. And there's no way they're thinking about these things unless educated people inform them of their decisions.
Well, the other part of it is it's taxed at in your tax bracket as income if it's not capital gains. Can you talk about that a little bit?
Yeah, less than 1 year, it's ordinary income. So let's say you make $300,000, $400,000, $500,000 a year, and you've bought and resold within a year. That goes into as if it was money that you earned in your job, and you're on a tax bracket. If you've held it more than a year, then it's long-term capital gain. And for the most part, there's exceptions, but the most part, you're fixed at 20%.
Yeah.
So I think that's an important thing, is understand that know enough of what's going on, and we don't need to be political prognosticators, but we do need to say, here are points to consider.
Right.
And down this road, this could happen. Down this road, you make the decision which makes most sense to you. But at least our job is to offer information. Their job is to make decisions.
All right, so let's see if I can sum it up here. 1031 exchange, great way to defer capital gains. All right. Learn what they are and how they work. It'll open up a big market for you with folks that are doing Airbnbs or investment type of properties or vacation rentals. It's a great business. I love it. You don't need to be an expert. You just need to know an expert and direct somebody to it. But I urge you to do a little bit of research on this and learn it so you can at least talk about it without seeming confused. All right. Because a huge part, well, this is my business, so we run into it all the time, but I would sell, but I don't want to pay the capital gain. Do a 1031. And as you learn more and more, you can figure out how to keep doing, you can do 1031s until you're dead, and then have a life insurance benefit, pay off any taxes so you can live tax-free forever.
That's what I was going to say is insure, die, and let the insurance pay the taxes for your heirs.
That's from an investment standpoint.
If they sell, right?
Yeah.
Maybe your kids will keep it forever. Who knows?
Yeah.
But it'll open up a market because most people don't operate from a real estate standpoint. They don't operate with investment properties or investors. This is a great way to do it, especially with the advent of the second home market becoming so popular with Airbnbs and just a great way to, because here, let's be honest, my goal here is to get you all earning enough income that you can buy cash flowing properties and build your wealth doing that. And 1031s are a massive part of that strategy.
It just helps you see the vision.
Yeah, for sure.
Yeah, and I do think it's important that we help people realize it is investment. They are investment properties, not the second homes.
Yeah. You
Be
can't
very
live,
mindful of that.
can't live in them. All right, so there you go. Thank you all for joining in. We'll have another conversation tomorrow. Mark, thank you for your insight.
You bet.
And see you guys soon. Good stuff.